welcome. You're watching Financial Planner, and today we're at the head office of M&M in Mumbai, where we are hosting a corporate event with Anand Rathi to try and help the employees of Anand Rathi to plan their finances and create their wealth management plan. M&M is a part of a $19 billion Mahindra group with a presence in automotive, agriculture and farm. Over the last many years, Mahindra has been steadily growing in stature as an international automotive major as well. Today, of course, a renowned name, not just in India, but internationally as well. Over the next 60 minutes, we will spend some time discussing the importance of debt in your portfolio, and also, of course, throw the floor open to questions from the employees of M&M to try and understand and help them plan their finances. To take that conversation with us ahead, we have with us Rakesh, Rawal and Feroze, Azeez of Anand Rathi. One of the cornerstones of getting a financial plan right in place is getting an asset allocation correct. So start by telling us the importance of asset allocation, and of course we can talk about the various verticals and the different attributes of getting the asset allocation correct.
The most important decision for an investor is what is known as asset allocation. Asset allocation is the proportion of money that I keep in different asset classes. Which are the four asset classes? Which are, real estate, equity, which are your growth assets, and debt and gold, which are your safe assets. Yeah. So the proportion of money that you keep in these asset classes is asset allocation. Obviously, if the proportion is more skewed to growth assets, you're likely to get more return, but you're taking more risk. Is that right? And therefore, it is really dependent on what your objective is. What is the objective of investing? What kind of return are you looking for? Right? Which will decide as to how you want to distribute your assets. Right? So, for a person, for example, who's a young person and has 20, 30 years of work life, right? Should he be looking at a conservative model or should he be looking at an aggressive model? Why do you need aggressive models for this gentleman? Because he has time on his side. He's not going to retire tomorrow. His stream of income is not going to disappear, right? And therefore, he can be more aggressive in his approach. For a person who's retiring, there's not too much energy left in terms of creating incomes. He has to be a little more conservative. So really speaking, asset allocation, as far as I'm concerned, is a key decision that depends on objectives. Set your objectives and then work your asset allocation through.
Right, for those in the portfolio, both assets have their own place and role to play. One asset can't replace the other. But in the recent past, of course, more often than not, when we talk about creating a wealth-creating portfolio, we talk about equities. And that's usually what the job or the role of equities is in a portfolio. And hence, I think debt is uncharted territory for a lot of investors. So why don't you tell us the importance of debt in one's portfolio, and even if one is a savvy investor, not necessarily a conservative investor, debt is still important, right?
Absolutely. Like Rakesh sir just mentioned, that asset allocation is going to be the key driver of your strategy, then it's important to understand might be relevant to most of us at different points in time and different stages of our lives. So having all the assets is a good start point. Now when it comes to debt, debt, if you are clear of what is the feature, what is the characteristic which I am looking in debt, which is stability, then it's very important to have debt in your portfolio if your objective allows you to have debt in your portfolio so that you can create stability in your portfolio. Now for example, you have to, if you have an all equity portfolio, you are going to certainly beat inflation over long periods of time. But the long term does not come unless you have gone through the short term. There's no shortcut to long term. So you have to traverse the journey of the short term to arrive at the long term. So investing is a matter of heart and the mind both. if I'm not able to address my heart and my capability to withstand the market volatility, utar chadav as they call it, then of course I will never reach the long term, and I might take sporadic emotion driven decisions, which is very detrimental to your portfolio. So to summarize, what am I trying to get to is, having debt for the right reasons, which is stability, is critical. But all said and done, objectives will derive, you will have to derive your allocation from the objective which you have set yourself. So that's the degree of customization for yourself you'll have to create before you embark on the journey, having large portions in debt, if at all.
So I think the top priority is getting your goals in place and put a timeline to what your goals are. And depending on those timelines, I think then you allocate your assets towards either equity or be it debt. Just to get one step further, when we think of safe assets, we usually think of fixed deposits, and that's what conservative investors, our parents, have done all their lives, really. But just talk to us about a little bit more about this, Rakesh, because beyond fixed deposits, beyond basic sort of debt instruments, there are a whole lot of other vehicles in the debt market, which one can, of course, look at, and then that would vary depending on the kind of risk profiling you have. So what are the various debt instruments getting beyond a bank deposit, which is the most common one that we ever talk about?
Well, you have a series of debt instruments. Your Provident Fund, for example, is one of the best debt instruments. You have various bonds issued by, starting from the government to companies which may go belly up tomorrow. So you have a whole profile of these bonds which are available, and then you have mutual funds which on your behalf invest into various kinds of debt instruments and manage the risks in a manner that it gives you reasonably good returns without taking too much of risk. So you have a series of all these instruments. What is common here? The common thing over here is that a debt instrument is that you've given your money to somebody who has contracted you two things. One, that he'll repay you that money back in a certain duration of time, and for this duration he will pay you an interest of whatever is predefined. So that's the common feature which is there for all debt instruments, right? So where's the risk? The risk is just two. One risk is he fails to pay you the interest or the principal back. Yeah, that's called credit risk. That's true for everything excepting government bonds, because the government can print money and meet its obligations, right? So that's one risk that you need to sort of look at. And the second is variation in interest rates. Yeah, so you can have an interest rate cycle going up, which will impact your returns, or interest rate cycle going down, that will impact your returns. So it's very simple, and I think that the range of returns, of course, can be a lot in this also, but we need to understand this as we go along.
Feroze, debt is usually synonymous with the word safe. We do know that if you invest in equities, for instance, in the shorter time horizon, it's usually a lot more volatile. It's usually more high risk, if I can say that. What are the attributes of debt investments? Are they generally viewed to be safer if the time horizon is shorter, and turn more risky as you, of course, look at a longer sort of time horizon?
Great. So after you've decided the asset allocation, the next decision is, what vehicle do I choose to participate in the asset which I've chosen for a certain portion of my money? Like it was just mentioned, there's something called an FD to something as much as a corporate deposit. So when it comes to safety, which is synonymous to debt, just like Samina mentioned, there are a couple of risks which were highlighted just now. Credit risk and interest rate risk are the two large risks which debt instruments can actually face. One instrument which does not carry interest rate risk, interest going up and down doesn't impact the value of your money, is a fixed deposit. A fixed deposit, second decimal, tells you what's your maturity, as long as the bank is not bankrupt. But a debt fund, for example, on the other hand, has some degree of variability because of interest rate movement. Why does it happen? Let me explain interest rate risk to you. If I have lent money to somebody at 8%, for example, tomorrow if the interest rates are at 10%, that means you have locked in yourself a lower interest rate than the market is achieving today. So your bond is at a discount because it has locked itself 8, but everybody else is getting 10. So your bond will no more be valued at 100 rupees, it will be valued at little lesser because it's at a disadvantage relative to the market. On the contrary, if you have locked yourself 10%, and if market interest rate goes down to 6, then your bond is at an advantage for it having been smarter to lock itself it has locked itself a 10% return. So it's going to quote more than 100 rupees. This phenomena is called interest rate risk. So a fixed deposit does not have interest rate risk. Debt funds have interest rate risk. Now to put things in perspective, in debt funds there are several funds. In debt mutual funds, there are several categories of funds. What is the least risk fund is what I think we should all focus on, because the mutual fund industry for its existence for 25-30 years has created enough complexity for addressing corporate needs. For individual needs, if you just focused on a category called short-term debt funds, which will have very minuscule risks and will be closer to a fixed deposit but can give you 2% more than a fixed deposit on a post-tax basis. So forget the rest of the 15 categories, just focus on a short-term debt fund so that I'm giving you specific recommendations so that you know you don't have to get distracted with other for 30
What is the ideal time horizon one should be looking at if you want to invest in a short-term debt fund?
See, when it comes to ideal time frame, there are two requisites. One is taxation, the other is return. Debt will be far more tax efficient for a person in the highest tax bracket if he or she held it for 3 years. So 3 years is an ideal period to bring tax efficiency, which is the reason why you have left your fixed deposits and gone to a debt fund. When it comes to return stability, a short-term fund can be bought for a year and you will still get a range of a return which is not as volatile. So from a return perspective, 1 year plus. From a taxation perspective, 3 years. Because after 3 years, you get into the long-term category and you get the benefit of indexation as per section 48.
We'll talk about taxation in a minute. But Rakesh, also liquid funds are getting very popular in the recent past. They're almost turning out to be a proxy to your savings account. Can you tell us the attributes of a liquid fund and why this may not be such a bad option even if you're a retail investor?
Well, a liquid fund is basically temporary parking for your money, and you normally use them when you're not sure as to when you'll require your money, right? And therefore, your option one is to keep them in your savings account, and option two is to put them in a liquid fund. In your savings account, though many banks say that you can get 4% odd, but there are some computations which they do in terms of which is the balance, which is minimum, etc., etc. So effective rate comes to about 2.5–3%. Whereas in a liquid fund, the same return works out in the region of 4–5%, and therefore you get an extra return in a liquid fund, and therefore, and in terms of safety, liquid funds are used by the best of corporates to park their money, so they are very, very safe. And for each one of us, if we've got temporary parking needs for your liquidity, liquid funds are very, very safe and more efficient.
Is there a bare minimum investment that you need to make in a liquid fund, unlike,
I'm not aware of any bare minimum. I think that...
So you can start as little as 1,000 rupees if that's what you want.
That's right.
Also, I think they've become a lot more customer or investor friendly, right, Feroze? Now I believe you get an ATM to use if you're using a liquid fund as opposed to a savings account at the bank.
Correct. So liquid funds, from a personal finance perspective, when I'm an individual, generally people have some money for contingency. Life always has surprises, so it's good to have 3 months' salary available to you on a day's notice. That's called a contingency fund. a contingency fund should be available to you. So if it has to be available to you, it should not earn you 2.5%. If it can earn you 5.5%, then you get twice more the interest. 2.5 and 5 look like a not too much of a difference, but if you're going to earn 10,000 rupee interest, now suddenly it becomes 20,000 rupee interest. And as we progress in life, and if you become senior citizens, then in this budget, there was an enhancement of a limit for senior citizens on savings account interest not being taxable from 10 to 50,000. So after you have progressed in the senior citizen category, maybe a savings account could actually come back, or a fixed deposit could be more beneficial. But as things stand today, for most of us sitting in this room, you would be better off in a liquid fund. Coming back to the convenience point which Samina just mentioned, to make sure that all of us use this instrument, which most of us end up needing it, not for a long-term plan, but for a parking. There are some asset management companies which is nothing but mutual fund companies, give you a 2 lakh limit every day to withdraw using an ATM. You can shop with it. You can withdraw cash with it. So it's as accessible as a savings account, and if it gives me 2-3 more times the return of a savings account, unless I'm in love with my bank and I want to support them, the savings account is redundant.
A bit of a dichotomy over here, because if you're a conservative investor, if you're looking for safe investments, if you require money over a 3-year period, then we recommend our investors or our audience to go after a short-term debt fund. But if you're a conservative investor, you'd imagine I'm going to go after debt as opposed to equity, even for a long-term portfolio requirement need. Now that's when debt turns risky, right? Because it's always tough to predict what the RBI is going to do in 10 years from now, if it's about a rising interest rate scenario or a lowering interest rate scenario. So is it fair to assume that even if you're a conservative investor, debt only for the short term is safer than equities? Either if you can take that.
Well, I think that there are two separate things, debt and equity. On a long-term basis, the volatility of equity sort of converges. And on a long-term basis, debt also is very small, the standard deviation or the volatility. So really speaking, when you are talking long-term, there's not, the differential risk comes down dramatically. Yeah. So I think that it's not that you choose equity vis-a-vis debt, or you take debt over equity just because in the short term the risk is differential, but not in the long term. So I think that asset allocation decision is more from a objective perspective. If you have need to, as Feroze said, create stability in your portfolio, then have that element of debt, and whatever be the ride of it in terms of RBI policies and so on and so forth, you have to ride with it. For example, today, if interest rates are low in a deposits, you ride with that. Tomorrow, for whatever reason they are higher, you'll ride with that too, right? So I don't think that your long-term decisions should be based on any other thing excepting your objectives. And these are two separate asset classes which will give you the return of the day, so to say.
I want to start with where we are today now. So as an investor, as a retail sort of audience who's with us today, we are out of a year which has been history making with regards to the equity returns that we've seen. We've also seen bond yields suddenly going out of shape in the last couple of months, if not longer. We're at a stage in life where the Reserve Bank of India is looking to raise interest rates once again. I mean, all of this, even retail investors who probably don't track markets on daily basis or the RBI on daily basis are beginning to track this, because we don't really know what lies ahead of us. So if we had to advise our audience over here, if you're looking at debt as an investment for the next 2 to 3 years, what is it that you're advising them to do?
Right. So 2 points. Point 1 is fixed deposits and debt funds sometimes have a huge arbitrage opportunity, and it is today. Fixed deposit rates have not gone up. They've just been on the downtrend, and even in the last 3, 4, 5 months, when Mutual fund returns can now, going forward, be very high. Fixed deposits have not increased their interest rate. So there's a huge arbitrage. So as a country, we are exposed to fixed deposits in a large extent. So this is the opportune time for you to make this 1.5–2% differential extra return in a debt fund. Why does this happen? Because fixed deposits don't get mark to market. What do you mean by mark to market? They don't go with the market. They've given you a commitment and they will live to the commitment as long as the bank is not bankrupt. But debt funds are mark to market. If the return in the past has been low, the debt fund's future returns could be largely higher, because the last year's return, 2017, has been the worst year for debt, at least in my recent memories. So if that is the case, 2018 is going to be relatively better, provided you get the second point right. If you are buying a debt fund for 3 years, make sure that the debt fund is also investing for 3 years. If there's a dichotomy between your investment time frame and the fund manager's time frame, then like Samina highlighted, debt could be risky even in the short run and also in the long run. So it is very easy to understand that. If you buy a fund, today it's very, very simple. There's so much secondary information available. If you went on buying, before you buy a fund, you have to check the maturity of the fund. Average maturity it is called. It will be available in public domain. If your average maturity of that fund is 10 years, but if you're buying it for 3 years, be in for some surprises, pleasant or adverse ones. But if it's a 3-year average maturity and you are buying it for 3 years, then it is unlikely that you will be getting very, very large difference from the expectation you had.
So very realistically, what are the kind of returns one can expect if you're investing in debt for a 3-year period? Rakesh, you want to take that? Especially with what we're staring at with regards to a rising interest rate scenario.
My sense is that deposits will be in the region of 6 to 7%, and debt funds will be in the region of 7.5 to 8.5%. That kind of return is likely.
We seem to be a very tax-saving nation. At least we try as Indians to constantly try and save tax, right? What about the taxation in debt? Because I believe that is fairly investor-friendly, if I can call it that. So if you can tell us what the taxation in debt is, and also quantify that for us for the sake of our audience with the help of an example maybe.
Right. So if you have to understand taxation in any context, we have to start with what are the 5 heads of taxation. Okay, Income Tax Act has 5 heads to taxation. So I will not bore you with all the 5, but I'll tell you the one which is specific, more or less related to investment world, which is capital gains or losses. Capital gain, head, capital income. So equity funds and debt funds, any gains you make upon sale will categorize itself in this category. The other 4 heads are not relevant from this investment world perspective. This is largely what you have to focus on. Now when you focus on this head, you need to understand that equity instruments or equity vehicles will have a different tax being in the same head. Debt will have a different tax being under the same head. Debt becomes long term. So under the head you have long term and short term. Long term for debt is 3 years. Long term for equity is 1 year. Okay? And lesser than 1 year is short term for equity. Lesser than 3 years is short term for debt. Taxation on long term for equity after this budget is 10% with no indexation. For debt, it is 20% with indexation. Like Samina pointed out, debt, because you get the benefit of indexation, which is a phenomena of you not paying tax on the inflated amount, because if you earned 8 rupees, government says don't pay tax on 8 rupees, pay it on 2 rupees, not on the entire 8 if inflation is at 6. If inflation is at 6, but if you earned 8, government says inflation I will not want to tax you. I will only tax you on the differential between 8 and 6, which is 2. That phenomena is called indexation. So 3 years you have to hold. So equity, very importantly, of course today we have the topic of debt. Now that we have Rakesh here, his expertise on equity and I think is valuable.
So we'll willingly take questions on equity, even though this conversation is about debt.
And I think Samina is rightly pointing questions towards an asset class, which is where Indians have put their money. So if you want to exit from debt, we'll have to know what we are letting go, right? As an Indian society, 60–70% of our savings go towards debt, which is supposedly, quote unquote, saying that I'm reducing risk.
And I think especially, Feroze, with what we've seen over the last 1–2 weeks, I think the change in perspective or attitude that was underway with retail investors suddenly flocking towards equities is once again gotten shaken up. So that stability that we were finding in equities may once again start attracting, rather putting away investors who once again may start looking at debt to find more safety.
I think it's important for us to reinforce into times like these when equity is going to be taxed at 10%, it is an advisor is duty bound to make sure the people whom he or she is advising are on the right path, which is equity. Like it was mentioned, if you compound your money at a larger value, even after tax, you will be left with twice, thrice more money in equity. So having the right proportion is critical.
Right, Rakesh, a very pointed question, and I'm going to ask you this because I think you as advisors will deal with this query a lot from your clients too. Why should one invest in accrual funds and avoid taking a call on duration funds? Now, give me a sense of why is that thinking and why is that advice out there for all our audience so you understand what accrual and duration calls are?
My philosophy is very simple, that if you got two parts of your asset allocation. The one part is where you are happy to take risk, and the other part is where you want stability. So if you take equity risk, the return that you get from equity risk is absolutely phenomenal, and the Sensex was 1980 it was 100 and today it is 34,000, 35,000. That's a 16–17% return average for a long period of time. No deposit, no debt instrument can give you anywhere near that kind of return. So therefore, you're taking risk and you're putting something into a box which is risk and giving you return. Then you've got your second box which says that, boss, I don't want to take risk here. Yeah, this is for my stability. Now, if you go in for duration funds, then the whole purpose that you had, that you want to make this less risky, is there's a question mark. Because Feroze just said that if you are putting that money for a 3-year period, and if you've got a bond with 10-year duration or time period of completion, then the behavioral type of that will bring large variation in your return, which is what you don't want. So be clear that if you go on asset allocation, then your debt side has to be stable, and stable you get through accrual funds and not through long dated funds. So it's not that long dated funds don't have a purpose. All one is saying is that you have to be clear as to why you've got that particular investment. If it is for stability, then it should be accrual funds.
Feroze, some people along with creating wealth may also look at a regular income from their investments. For such individuals, for such investors, is debt fund an ideal or recommended investment vehicle?
Yes, if you are in a phase of life where you want regular income from your investments and you've reached a place where you've actually accumulated a lot of money and now you want to enjoy the benefit of that, of course debt becomes an integral part of a portfolio created with this objective, and a large portion of that has to be debt because equity will have some degree of variation and requires 5, 7, 10 years for it to pan out the way we envisage it to be. So debt is an integral part of debt will help you serve this objective. But second thing which I would like to say is that whenever you have debt, it's important to realize that you should not choose a dividend option in a debt fund, because there is a dividend distribution tax which is enormous, which is as much as 30%. So you should choose a growth option in your debt schemes. If you chose a growth option, how would I meet my regular income? That becomes a counterintuitive advice. Now I'll tell you why am I actually getting there. So point 2 which I'm making is, don't choose dividend option, choose a growth option. Now you want regular income in a growth option. As the nomenclature suggests, it is growing. But there is another phenomena or a nomenclature which you need to remember, which is called systematic withdrawal plan, SWP, which all mutual funds in the debt category help you withdraw money on a consistent basis, and you can tell them the date of a specific month or date in any month, a specific date where they'll credit you this money and regularly. If you do SWP, your taxation would be far more efficient than choosing a dividend option.
Also, Feroze, apart from regular income, SWP is a phenomena, may be useful even if you're looking to do an SIP into equities, right?
Correct. So
while you're waiting around in the sidelines, as opposed to having your money in your savings account, you can keep it, of course, in a debt fund and then do an SWP and then move it to equities, right?
Correct. So there are three important things. SIP is a systematic investment plan. Systematic withdrawal plan, as the nomenclature suggests, is a mechanism or an instruction to the mutual fund company to credit you a specific withdrawal on a monthly basis. Between these two is something called a systematic transfer plan, STP. Like Samina mentioned, you might put your money in debt and gradually move that money into equity. Right or wrong, we can debate that, but that is different for different people, so can't be generalistic. But if you so chose to do it as a part of your strategy, systematic transfer plan, the money goes into debt, and you tell the asset management company that on a monthly basis or even a weekly basis, transmit this money from debt to equity, because I don't have the courage to put all my money in equity at once. So that's called a systematic transfer plan. Systematic investment plan, systematic transfer plan, and systematic withdrawal plan are the three abbreviations. If you are investing in mutual funds, it's important for you to understand them and apply them wherever necessary.
Rakesh, I know it's always tough to generalize a financial plan because, of course, the financial plan comes with an enormous amount of customization because you have your own goals, you have your own responsibilities, your own time horizons. But just for the sake of our audience, and of course we'll take more pointed questions from them as well, but could you give me a sense of what is the asset allocation to wrap this conversation up, which is the ideal asset allocation in terms of percentage between debt and equity that one can look at, and then of course we work around that in a more customized manner?
Well, my belief has been that if you're young and if your expenditure is less than income, try and visualize as to what period do you think your income is going to be higher than expenditure, right? So if you can see that, hey, for the next 5 years, 10 years, 15 years, I'm likely to earn more than my expenditure, then whatever money that I'm setting aside will only come to use post that period. That's logical, I suppose. So therefore, money, if you're setting aside for long periods of time, should be significantly into equity so that you allow it to grow, because you have the time to, go through the ups and downs of the market, right? And therefore the return will come because you've kept it invested for long periods of time. So barring some levels of liquidity needs that you might have in terms of contingencies, significant part can be in the equity space. So, however, when you come to my age and Feroze is ready to take over, then I think I need to change over my asset allocation.
We'll open the floor to taking questions from all of you. It can be specific, customized questions or queries that you have. It's not often you're going to get Rakesh and Feroze to take those personalized questions. And yeah, we can just go as we go along. Doesn't have to be debt. It can be equities. It can be Bitcoin, real estate, gold. Those asset classes Feroze and Rakesh love, don't they?
I'm Sam Thomas. Till some time back, any financial advisor, they used to advise, be it in the newspaper or television, first thing they used to advise was go for PPF and the advantage of compounding. But now the rates in the PPF has dropped down so much. So is it now, and now any financial advisor, they talk of mutual fund. So is it advisable to remove all your PPF money and put into mutual fund, or let it continue for the full tenure?
Well, I have this one broken record which you will hear again and again, which is, if you have your objective, you have your asset allocation between equity and debt, PPF is a debt instrument, right? So if you are adequately covered in equity and the balance debt is covered by PPF, PPF is a very good instrument which will have comparable returns in debt funds as well. But if your asset allocation is skewed, which means that you have less equity than you desire, then take out money from PPF and put it into equity.
Maybe the partial amount if we taken out.
Well, if you got other liquidity to put that equity, then take that. Why would you want to take it out of PPF? Right? So again and again, please, just one point to all you people, do your plan, have your objective, have your asset allocation in place, and then choose instrumentation. Very boring, but investment is boring actually. You try and make it exciting, you lose a lot of money.
No, then you just head to the casino instead. It's just easier.
Hi, this is Samik. Just wanted to know how good are balanced funds and how long should we invest into that, and what should be, I mean, with a growth option as you mentioned. So how good it is and how long should we invest into it, and whether should we actually invest into it?
So balanced funds actually as a category is, as the name suggests, puts money in equity, puts money in debt. That's why it's called a balanced fund, right? It saw the maximum amount of inflow in the year 2017. Now it's a pertinent question, Samir. Should we continue investing in balanced funds if at all you are? How much practical sense do they make? In our opinion, they're again a redundant category because the asset allocation has to be specific to me if it's my plan. It has to be specific to you if it's your plan. A balanced fund, a fund manager puts 65% in equity, 35% in debt. You're outsourcing the job to the fund manager to do asset allocation, and all of them, one size fits all on asset allocation doesn't work. You have to try and see what stage in life you are, what are your goals and stuff. So the reason why we are in this 1 hour conversation harping upon goals so much is because it is seldom found. Out of 100 people you meet, only 1% actually pursues the objective based management of money. Most people actually go transaction by transaction. It is important to draw up a context. In every walk of our life, we have an objective, but in investments, there is some psychological barrier where goals are not being given adequate importance and transactions are being given adequate importance. So coming back to your point, Samir, balanced funds are not good because they outsource the job of the most important element of investing, which is asset allocation.
Nidhish Kuchal. My question is about asset allocations. Like we all salary class already have a provident fund. So that take care of a part of debt management. Is it right thing to do so?
Absolutely.
Yeah. Second question is when we go for investment in mutual fund, there are options now direct plan available. What is your take on that? And whom you suggest to go for a direct plan instead of a distributor plan?
The question has the answer. If you don't need the distributor to advise you in terms of selection of funds, then go direct. But you must also understand that there are close to about 300-400 equity funds today. 400 equity funds, and you need to choose 5 or 6 or 7 or 8 funds out of those 400, right? And the variation of return is massive. So therefore, if you think that your distributor can help you in choosing those wisely, then don't go for the direct plan. If you think that you can do that on your own, then go for the direct plan.
Yeah, because normally even the ratings and the last 5-year ratings and all that is available in published reports. So what is the contribution we can look forward?
See, the point is that it's not just the ratings, okay? Now there'll be, in terms of rating, there'll be 50 funds with certain ratings, right? And so there's a whole lot of science in terms of selection of funds, which is not just the past performance. There are several aspects of it which you look at as a advisor and then come to a recommendation, right? And if you see that there is value in that, then you shouldn't be worried about a little bit that the advisor makes. But if you don't see value, why the hell should he take any money?
Surely, thank you.
To add to this point a little more, if you're looking at investing in mutual funds, you have to also understand that past performance is not a very, very good indicator of the future, which is what we hear at the end of the advertisement. If past performance is not going to be indicating the future, then what will? Right? Is there an answer to it? Statistics has an answer to it called predictive analytics, which helps you better predict the future of a fund. Will a public domain rating help you understand that? The answer is no. There's a second element. It is not just the fund name. We have to go behind the fund name. The person who named the fund is the fund manager. Will a retail investor get access to the fund manager to understand his thought process or her thought process in terms of what are the future prospects of the companies which he has bought on your behalf? So there is a lot of science which can go through. Then the end of it, the proof of the pudding is in the eating. If you actually use these two methods of interaction with the individual and predictive analytics, there's a huge difference between the performance on the basis of ratings or these two methods, and you end up saving 1%, but you might end up spending 5% of lower return. So I very strongly suggest, if you don't think that this distributor can add value, go in search of somebody else who can add value rather than direct.
Yeah, hi, this is Satish. My question is, apart from the two asset class which you mentioned, debt and equity, just your one-liner or two-liner views on the other asset class, which includes real estate, gold, and most recently cryptocurrency. And the second part of the question is that for as you keep on saying, depending on the objective, for a young people who have just joined the organization who look forward for a longer career, what is the right percentage at asset allocation when it comes to real estate, gold, debt and equity?
Real estate, unfortunately, is going through a correction phase, and therefore is unlikely to create great returns in the medium term. So it has more aspirational kind of purchasing today, which means that a young person has an aspiration to buy a house and create security for his family, and that's the reason why a person should be in real estate, at least today. At a point in time when the correction sort of settles down, and then there is again the kind of return expectation that you can get from that asset class, then it becomes a asset class worth looking at for investing purposes. Right? As far as gold is concerned, I think that 15% of the global demand for gold is India. A large portion of that global demand is also from rural India, wherein the poor lady has to have gold as a means of security because she didn't have access to any kind of financial bank account or any of that. And therefore just picture that lady and say that, hey, they are facing some problems. How does she feed her family? So it used to be gold which used to be pawned or sold, and then, But if the banking system and with the current government, you're opening crores and crores of bank accounts. Do you see this changing in some fashion in terms of the people, looking at gold as an alternative to a bank account? So therefore, I believe that with time, the gold demand in India will also come down, but with banking system sort of percolating to the last nook and corner of the country, and therefore will have impact on global prices as well. So my sense is that stick to equity for growth and debt for stability, right? And if I am a young person, when I was your age, I had nobody to guide me, but I did guide my daughters, and I said to my daughters, be 100% in equity. But you just have a look at your own life and see what kind of contingencies you want to keep there. But I personally don't see why the saving is not long term, because if I have a job which is giving me. And if you're working for a wonderful company like Mahindra, you shouldn't be worried. Cryptocurrency, I have no clue.
So, cryptocurrency, bitcoins and other cryptocurrencies which have emerged, of course, because of the kind of attention they have grabbed, you might be tempted to actually get yourself a little portion of your money in cryptocurrencies. But very importantly, there is a fundamental principle of investment which is getting flouted, which is in assets have to be creating value to themselves. An asset, it can't be a currency. A currency cannot be used as an asset. That's what is happening. Nobody's spending money or transferring value in cryptocurrencies. They're actually using that as an asset, right? When you buy equity, there are lakhs of people who go to the company and work there so that I, as an owner of equity, is actually making money. So there are human beings who are working, like Mahindra and Mahindra. We all come to work. You come to work and create value for the shareholder. Who's doing that in the cryptocurrency? So it is a speculative game. Of course, you're going to feel left out when in a coffee table conversation, when people are going to speak about cryptocurrency. You're going to feel left out. You're going to feel dumb. But you're better dumb than getting into something which has a design flaw.
This is Prashant Chandak. My question is not about any asset class. How does one choose an advisor?
See, this is the most important question. Sorry, I missed your name. Prashant. Prashant has asked the most important question. See, if you've got the right person by your side, the odds that you will meet your objectives will shoot up dramatically. So, how do you choose one? In my opinion, there are three key attributes of an advisor. Fortunately, some of them are measurable out of these three. The first most important attribute is capability. Capability is measurable, right? So we have to ask what kind of returns has his portfolio or her portfolio generated. A person uses his capability to his money the most. So finding out what are the audited returns and risk of his portfolio will give you a good idea of the capability. Second is trust, right? Now trust is a very soft aspect in life. We think that it is not measurable. Fortunately, in the investing world, it is measurable. How do you measure trust? Is to see whether the advisor is doing similar stuff as he is advising to you. For example, in demonetization times, I got very good service from my banker. I was very excited. At the end of 31st of December 2016, my banker called me and said, I gave you such good service where people who were standing in queues, I used to give you money with not long waits. Why don't you put money, 3 lakh rupees in this insurance policy? My only question was, if it's such a good insurance policy, give me one statement of your relative and take the 3 lakhs from me. He didn't turn back up. So the point is, how do you check the trust is there has to be an intersection between what your advisor does with his money and what you do with your money. The last thing is he or she needs to have commitment to you. If he is capable, trustworthy, but he has 100 other customers whom he has attached himself to, then that capability and trust is not useful to you. So commitment is another measurement, which is unfortunately not measured unless you start dealing with that person. If you don't see commitment in that relationship, he or she is not a good advisor. So these are the three important elements. And I think, Prashant, this is the most important question. If you got this answered right, and if you made this check whether your advisor is on your side or against it, it will help you go a long way. Suddenly waking up and asking the advisor to bring his statement and then seeing how much is intersecting will be a good measure to see whether there's vested interest advice reaching you or actual good advice reaching you.